Four companies have now spent more than $1 trillion building the infrastructure behind artificial intelligence. Not promised, not valued on the stock market, spent on chips, servers, data centers, power, cooling, fiber, land, and contracts that can lock them into even more spending for years. At $1 million a day, it would take almost 2,740 years to spend $1 trillion. Big tech moved that kind of money in roughly 3.5 years. And now, Wall Street is asking a question that sounded almost impolite during the first phase of the AI boom. Where is the profit? The latest earnings season created a remarkable split screen. Microsoft reported powerful cloud growth, and investors added nearly $450 billion to its market value in a single day. Amazon revealed an even larger spending plan, yet its shares surged because AWS was accelerating. Alphabet showed explosive growth in Google Cloud, but its quarterly free cash flow turned negative. Meta grew revenue rapidly, yet its costs rose even faster, its operating margin fell, and its free cash flow nearly disappeared. Same technology, same race, completely different reactions. Why? Because Wall Street has changed the question. The market is no longer asking which company believes in artificial intelligence. They all believe. It is asking which company can turn artificial intelligence into cash before the machines become obsolete, financing becomes expensive, or the next generation of models changes the economics again. There is one clarification. The trillion-dollar figure is not a perfect audit of money spent exclusively on chatbots. It tracks the enormous capital expenditures of Amazon, Microsoft, Alphabet, and Meta since the AI boom accelerated in early 2023. Some of that money also supports broader cloud systems, networking, logistics, and other infrastructure. But the direction is unmistakable. Artificial intelligence has transformed software companies into some of the largest construction companies on Earth. An AI service may feel weightless on your screen. You type a question, a response appears. But behind that response sits a physical industrial system, thousands of processors inside server racks, buildings connected to huge supplies of electricity, cooling systems removing the heat, fiber networks moving the data, long-term contracts signed before some facilities are even complete. The AI revolution may be digital. The bill is very physical. This is where accounting can hide the tension. When a company buys a data center, it does not normally record the entire cost as an expense immediately. The cash may leave now, but the asset is depreciated over years. That can allow reported earnings to remain strong while free cash flow is under pressure. And AI equipment creates a special risk. An office building can remain useful for decades. An advanced processor can lose strategic value much faster when a new generation arrives, when cheaper custom chips appear, or when software becomes more efficient. The real question is therefore not simply whether revenue is rising, it is whether the infrastructure can earn back its full economic cost before its advantage disappears. Microsoft gave investors the clearest version of a yes. Its intelligent cloud division generated $39.3 billion in quarterly revenue, up 32%. Azure and other cloud services grew 43%. Microsoft still plans enormous investment, but it is showing a visible feedback loop. It builds capacity. Customers rent that capacity. Cloud revenue rises. Cash returns. That is why the market rewarded Microsoft so dramatically. It was not celebrating spending. It was celebrating evidence that spending was becoming revenue. Amazon delivered a similar message, but with a more extreme cash flow trade-off. AWS sales reached $42.2 billion in the quarter, up 37%, its fastest growth in 18 quarters. AWS produced $16.6 billion of operating income. Amazon also said its AI and chip businesses had each passed annualized run rates of $25 billion. That is real demand. But Amazon raised expected capital spending for the year to roughly $220 billion. And over the previous 12 months, free cash flow fell to negative $7.6 billion, largely because purchases of property and equipment increased sharply. Both facts can be true. The business can be booming, and the investment required to serve that boom can consume more cash than the company produces. Alphabet shows the same contradiction at even higher speed. Google Cloud revenue rose 82% to $24.8 billion. Yet Alphabet spent almost $45 billion on capital equipment in one quarter, roughly twice the amount from a year earlier. Quarterly free cash flow fell below zero. That does not mean the investment failed. It means the investment arrived before the return. And when hundreds of billions of dollars are committed before the return is visible, time becomes a financial risk. Meta faces a different problem. It does not have a cloud business the size of Azure, AWS, or Google Cloud that can directly rent computing capacity to outside customers. Its AI systems already improve recommendations and advertising. That benefit is real. Meta's quarterly revenue grew 28%, but costs and expenses grew 55%. Operating margin fell from 43% to 31%. Capital expenditures reached more than $31 billion. Free cash flow was only $784 million. For an ordinary company, that would be enormous. For Meta, compared with the scale of its investment, it was almost a rounding error. This is why Wall Street treats each AI dollar differently. A dollar spent by Microsoft can become an Azure bill. A dollar spent by Amazon can become an AWS contract. A dollar spent by Meta must often prove its value indirectly through better advertising, stronger engagement, or a future product. The infrastructure may look similar. The path back to cash is not. And now the financing is changing. For years, the largest technology companies could fund expansion from their own enormous cash machines. But the AI build-out is so large that debt, leases, joint ventures, and project finance structures are becoming more important. By early July, AI-related bond issuance had reportedly reached about $270 billion, almost double the amount raised during all of 2025. Meta alone had raised more than $55 billion through bond sales over roughly 9 months. Debt allows a company to build today and pay over many years, but it also creates a fixed obligation. Customers can reduce usage. Technology can change. Prices can fall. Interest still has to be paid. This is the hidden wager inside the AI boom. Big tech is not merely betting that artificial intelligence will become useful. AI is already useful. The real wager is that demand for computing will grow fast enough, for long enough, and at high enough prices to justify the infrastructure being built today. The bullish case is powerful. Cloud growth is accelerating. Businesses are signing long-term contracts. Capacity remains constrained. Better models can create new products and new categories of demand, and when AI becomes cheaper, people may use far more of it. But the bearish case matters too. Models are becoming more efficient. Competition can push service prices down. Custom chips can reduce dependence on expensive processors. Electricity and memory costs can rise. A machine expected to earn money for 6 years may lose its advantage in 3. The race is already affecting companies outside the cloud leaders. Apple warned that component shortages were constraining its outlook as the data center boom placed pressure on global supply chains. Its shares fell sharply. Big tech's AI spending is no longer contained inside big tech. It is changing the price and availability of memory, electricity, construction, financing, and specialized labor. So how will investors know who is winning? Do not watch the size of the spending announcement. Watch what comes back. Can the company identify new AI revenue? Are the expensive servers being used? Do those services generate attractive margins after energy, chips, and model costs? How much free cash flow remains after the infrastructure is paid for? And is the return greater than the cost of all the capital committed? Those measures will separate productive infrastructure from expensive monuments to fear, because fear is a major force in this race. Every chief executive knows what happens if a rival builds the dominant AI platform first. Customers can become locked into another cloud. Developers can build on another ecosystem. The best researchers can move elsewhere. So even if executives privately worry that the industry is building too much, none of them wants to be the first to stop. One company announces a larger data center. Its rival responds. Suppliers expand. Debt markets provide more money, until the market stops rewarding ambition and starts demanding evidence. That moment may have arrived. Microsoft was rewarded because the evidence looked strong. Amazon was rewarded because AWS growth accelerated despite the spending. Alphabet showed extraordinary cloud momentum, but also demonstrated how quickly cash can disappear. Meta showed that even powerful revenue growth may not be enough when costs rise faster. This is not proof that the AI bubble is about to burst. It is proof that the blank check phase is ending. The first $1 trillion bought possibility. It bought the chips, buildings, and electrical systems required to test whether artificial intelligence could become the next great computing platform. The next trillion will face a harder standard. It must buy customers. It must create durable margins. It must produce free cash flow. And it must do so before today's machines become yesterday's technology. For the last 3 years, the winners of the AI race were the companies willing to spend the most. From this point forward, the winners may be the companies that can prove something much more difficult: that the machines are creating more cash than they consume. Because $1 trillion was the price of entering the race. Profit is the price of staying in it.